Welcome. Today, we're diving into a really critical part of the new Income Tax Act of 2025, and that's Section 71. You can think of it as the capital gains clawback rule. Now, if you're involved in any kind of corporate reorganization, you absolutely need to know how this works. So let's get right into it. So picture this. Your company moves a valuable capital asset over to its wholly owned subsidiary, and you do this tax-free, claiming an exemption that's meant for genuine business restructuring. But what happens if a few years later you decide to sell just a small stake in that subsidiary? Or maybe the subsidiary itself decides, hey, let's treat this asset as inventory now. Well, that's the exact situation that Section 71 is built to address. Here's a quick look at how we're going to break this down. First, we'll touch on the corporate exemption itself. Then, we'll jump into the Section 71 clawback rule and what triggers it. We'll also look at how this transitions from the old act, run through an example, cover some practical compliance issues, and then wrap up with the key takeaways. All right, so to really get why this clawback rule is so important, we first have to understand the benefit it's there to protect. You see, the Income Tax Act has specific exemptions built in to help businesses restructure efficiently, and that's really our starting point. The whole idea, which you'll find in provisions like Section 70 of the 2025 Act, is pretty simple. When you move an asset between a parent company and a subsidiary it owns 100% of, that's not really a sale to an outsider, is it? It's more like an internal shuffle. So, to make these genuine business reorganizations easier, the law says, okay, you can make that transfer without taking an immediate capital gains tax hit. And this slide really lays it out perfectly. On the left, you've got the intended purpose, a genuine reorganization where the asset stays in the group and is used for the business. But on the right, that's the potential loophole. An asset gets transferred tax-free, and then the subsidiary quickly sells it or calls it stock in trade. This could be a way to sidestep the capital gains tax the parent would have had to pay. And that is exactly what Section 71 is designed to stop.
Okay, so let's get to the main event, the rule itself. Section 71 is basically the safeguard, the watchdog for that corporate exemption we just talked about.
So what is Section 71 in plain English? Well, it's an anti-abuse rule. It essentially makes that tax exemption conditional. If you break certain rules within a set time frame after the transfer, the tax benefit gets pulled back, retroactively. A really simple way to think about it is like a conditional gift. The government lets you move the asset tax-free, but it comes with strings attached. You have to maintain the business structure and the asset's purpose for a while. If you break the rules of the gift, you have to give it back, in the form of paying the tax. And what is that while? How long do you have to follow the rules? It's 8 years. This is the magic number, the key time frame you have to burn into your memory. The whole point of such a long period is to make sure these reorganizations are for real, long-term business strategy, not just some short-term trick to dodge taxes. This lock-in is the heart of the whole provision. Okay, so we know there are rules, but what exactly are they? What actions will actually set off this clawback? Let's decode those trigger conditions. There are 2 main triggers to watch out for. First, if the subsidiary that got the asset turns around and converts it into stock in trade. Basically, they start treating it like inventory they plan to sell. That's a huge red flag. The second trigger is if the parent company no longer owns 100% of the subsidiary. And I mean 100%. Selling even a single share breaks this condition. If either of these things happens inside that 8-year window, boom, the clawback is triggered. And here's the most critical part. The consequence. When the rule is broken, the tax isn't charged in the year you broke the rule. Oh no, the law actually reaches back in time. The capital gain that you got for free is now considered taxable income for the year the transfer originally happened. This is a huge deal, with major implications for interest and even potential penalties. So that brings up a really important question for all of us professionals. What about all those transfers that happened under the old 1961 Act? Does this new law reach back and affect them too? The answer is a clear and simple yes, it does. The key piece of the puzzle here is Section 536 2Q of the new Act. Think of it as the bridge provision. It's a savings clause that basically says, hey, that 8-year commitment you made under the old Section 47, it's still on. So if you break the rules after April 1st, 2026, you'll be dealt with under this new law. This timeline shows you exactly how it works. So let's say an asset was transferred tax-free in the 24-25 tax year under the old law. Then in 2026, the new Act kicks in. Fast forward to 2028, and the parent company sells off some shares. The rule is broken under the new Act's watch, but the tax consequence, it snaps right back to the original transfer year of 24-25. Let's put some real numbers on that timeline to make it crystal clear. H Limited transfers an asset that's worth 2 crores, which it bought for 50 lakhs, to its subsidiary S Limited. This happens in tax year 2024-25, and it's exempt. But 4 years later, in 2028, they meet one of those trigger conditions. The calculation is pretty straightforward at this point. The fair market value at the time of the original transfer, in our case, 2 crores, is considered the sale price. We subtract the original cost of 50 lakhs, and there you have it. A capital gain of 1.5 crores that was initially exempt is now fully taxable. And as the table clearly shows, the killer detail is when it's taxable, back in tax year 2024-25. You know, understanding the law is one thing, but making sure you're compliant day to day is a whole other ballgame. Let's talk about the practical stuff that professionals really need to stay on top of. Okay, meticulous record keeping is just not optional here. You have to keep everything, the board resolutions, the transfer deeds, and especially clear proof that you maintained 100% shareholding for that entire 8-year stretch. Your fixed asset register should also clearly flag these specific assets so you can monitor them. And remember, the new income tax rules for 2026 might give us even more detail on how these records need to be kept. So, for all the pros watching, your mantra should be track, advise, and document. Keep a master list of all these transfers and their 8-year expiry dates. Make sure the advice you give your clients about this lock-in period is crystal clear and in writing. And finally, always document the genuine business reason for the transfer right from the start. That could be your saving grace if the transaction ever gets scrutinized. Okay, we've covered a lot of ground, so let's boil it all down and summarize the absolute key takeaways from our discussion today. If you walk away with anything today, make it these 4 points. 1. Section 71 means a strict 8-year lock-in period. 2. The main triggers are converting the asset to stock or breaking that 100% shareholding. 3. This rule absolutely applies to transfers that were made under the old 1961 Act, thanks to the transitional provision. And 4, probably the most important point of all, the tax liability always goes back to the year of the original transfer. Thank you so much for joining us for this deep dive into Section 71. If you found this useful, please do us a favor and hit that like button, subscribe to the channel for more explainers like this, and of course, share it with your colleagues. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.